If you plan on flipping a house to a first-time home buyer that uses FHA financing, you better be intimately aware of the FHA anti-flipping rules and restrictions, or it could kill your deal. In fact, I'm dealing with this exact scenario right now on one of my flips, which I'll use as a case study. So in this video, I'm gonna break down everything you need to know about the FHA anti-flipping rule and how to flip houses to FHA buyers coming up.
The Real Estate Funding Kit is out now. Learn how to get 100% funding for all your deals without dealing with the banks. Claim your free copy at myfundingkit.com.
If you're new here, I'm Jerry Norton and I went from dead broke to millionaire flipping houses. And after doing 1,000 deals, I created this channel to help you master the art of wholesaling and flipping real estate so you can live your dream life. Be sure to subscribe and click the bell icon to get notified when new videos are released. Before I dive into FHA's anti-flipping rules and how it will affect your ability to flip houses, first, let me take a minute and explain FHA. FHA stands for Federal Housing Administration. It's a government agency created in the 1930s to help stimulate the housing market, and it's still a very popular loan program for qualified borrowers. It's important to know that FHA is not a lender, but rather an insurance program. Now, the way it works is a borrower gets a loan through an FHA-approved lender, and then FHA insures the loan. In other words, if the borrower defaults on the loan, FHA pays back the lender. And since FHA is the government, and since you and I finance the government with our tax dollars, technically, you and I pay back the bank when an FHA borrower defaults on their loans. But that's beside the point. The reason why FHA loans are so popular is because they have lower requirements for borrowers to qualify than conventional loans. Remember, the point is to help people buy homes that can't qualify for traditional conventional loans. Now, there are actually 3 benefits to FHA loans over conventional loans. The first benefit is FHA has a lower down payment requirement. Most conventional loans require 10 to 20% down payment, whereas FHA only requires a 3% down payment. Now, to put that in perspective, if a buyer is purchasing a home for $120,000 using conventional financing at 20% down, they would have to come up with $24,000 for the down payment instead of only $3,600 with a 3% down FHA loan. That's a huge difference. The second benefit to using an FHA loan is borrowers can qualify with a lower credit score. Conventional loans typically require a minimum 620 score, but FHA will go as low as 500. Now, the third benefit to an FHA loan is lower closing fees in the form of seller concessions. FHA will allow up to 6% in seller concessions. Now, let me explain using my current deal as an example. I received an offer on my flip for $116,000 with $4,500 in seller concessions. That means at closing, I would pay $4,500 from my proceeds to cover the buyer's closing fees. Now, what usually happens is an FHA buyer will try to finance the concessions by offering to pay more for the house. On my deal, the house was listed for sale for $115,000, so his $116,000 offer with $4,500 in concessions is the same as $111,500 without concessions. Now, I actually countered back at $120,000 with $5,500 in concessions instead of $4,500, which is $114,500 net to me, and they accepted. And the concessions can apply to fees such as the appraisal, prepaid property taxes, prepaid interest, recording fees, lender origination fees, title search, and insurance costs, FHA inspection fees, etc. That's a big deal for the borrower because he doesn't have to come up with as much money to close, but it does present a problem for the flipper because it may not appraise now, which is a big concern for me on my deal, which I'll cover in a minute. And since I bought this house for $52,000 and I spent $19,000 on the rehab, I'm all in on the deal for like $71,000. So after commissions, closing fees, and concessions, I'll net approximately $31,000 in profit on a house I've never actually seen in person. If you think that's a great little fix and flip, leave a comment and say, Jerry, you are a flipping genius. And if you want to learn how to flip houses virtually like me, I put together a kit to help you get your first virtual deal in the next 30 days, and I'll give that to you for free. Just go to virtualflipperkit.com. But let's not get ahead of myself. I've learned in this business not to count my chickens before they've hatched. I have to make it to closing, and because of the FHA anti-flipping rules, there's some hair on this baby. Keep watching and you'll see what I mean. Back to FHA. The downside to borrowers is FHA has a loan limit. Remember, the idea is to help first-time buyers. The loan limit fluctuates year over year and it's factored by county, but just to give you an idea, in low-cost counties such as Lucas County, Ohio, where Toledo is located, the FHA limit is $331,000. Whereas the FHA limit in higher cost counties such as San Francisco is like $765,000. So what does this mean if you're a flipper, and why does it even matter? Well, first of all, if you flip houses to retail buyers where the price point is within the FHA limits, more than likely you're going to get a lot of FHA buyers. And the lower you go in price, the higher likelihood that your buyer is FHA. For example, if you flip houses under $150,000 sale price, there is a 99% chance your buyer is going to use FHA financing and a really high chance that they're going to ask for seller concessions. Now that's fine, that's not a problem. The problem is FHA has anti-flipping rules to prevent smart, rich people like me from buying a house today and then reselling it to an FHA buyer tomorrow for a profit. That's not fair. Have I ever told you how much I love the government? So if you flip houses or plan to flip houses to FHA buyers, you need to understand the FHA anti-flipping rule. There are two seasoning rules that you need to know about. First is the 90-day seasoning rule. FHA requires that the seller, you the flipper, own the property for 90 days from the purchase contract date. Now, I hope you caught that. It's not 90 days from the day you purchase it to the day you close with the FHA buyer. That would be awesome. It's 90 days from when you bought it to the day you sign the purchase contract with the FHA buyer. That's a big difference because it usually takes FHA 45 days from contract to close. So if you're flipping a house that takes you longer than 90 days to rehab it and get it back up for sale, then you don't have to worry about it. But if you're like me and you get the rehab done in less than 90 days, this is a big deal because the FHA 90-day rule is going to be an issue, which is exactly what's happening to me on my fix and flip deal. Let me explain my situation as well as how I'm handling it so you know what to do if and when it happens to you. I purchased the house on September 25th. And today, at the time of recording this video, it's December 9th, and I just accepted an offer from an FHA buyer today. Now, I hope you caught the problem. I'm 17 days away from the 90-day mark, which would be December 26th. What a mess. Now, luckily, I've been in this situation before, and I know what to do. Here's how we're handling it. We signed the purchase agreement and opened escrow today so that we officially have a deal with the buyer. Now, between now and December 26th, the next 17 days, the buyer's going to do their inspection, which I offered to pay for. Why? It's only $300, and I want the buyer to feel good that if for any reason whatsoever something happens, he's not out any money. Then on December 26th, we're going to cancel the existing contract with a mutual release and sign a new contract dated December 26th, which would be exactly 91 days from when I bought it. And then we're going to waive the inspection because it was already done, and then submit everything to the lender and order the appraisal. Now, as a flipper, you better hope that your listing agent and the buyer's agent is on board with this. Now, luckily, the buyer's agent is really good, and my brother Kevin is my listing agent, and he's a rock star, so I think we'll get it done. Now, I wish that was it. FHA has another seasoning rule from 91 days to 180 days. Still using the date the deed was recorded when you, the flipper, bought it, if the seller, you, the flipper, bought the home within the last 91 and 180 days, which is going to be the case for most deals you do as a flipper, then to make sure that there isn't any fraud going on, FHA requires a second appraisal if either the FHA buyer's purchase price is 100% or more higher than what the flipper paid when he bought it, or if it's a higher price loan and the home's sale price is 20% more than the seller's purchase price. So for my deal, I bought it for $52,000 and my contract with my FHA buyer is for $120,000, which is more than 100%. So my deal is going to require 2 appraisals, and I'm pretty concerned about that because the ARV on my house is $115,000. But as I explained earlier, we bumped the price to $120,000 and I'm giving the buyer $5,500 in concessions. So now not only do I need it to appraise for $120,000, I need 2 appraisals for $120,000. Now, if it doesn't, I'll have to either cancel the contract and start all the way over with finding a new buyer, or I'll have to just lower the price because there's no way the buyer is going to pay the difference no matter how bad he wants the house. Remember, he doesn't have enough money, which is why he's asking for seller concessions. Now, luckily, neither USDA nor VA loans have seasoning requirements like FHA, so those buyers are gold for quick turn flippers. And one final tip, I've had FHA come back and question the legitimacy of my rehab to verify I actually earned my profit. Now, as stupid as that is, always document all of the work you do on the property in case FHA wants proof. Now, I typically create a before and after slideshow that I can easily provide FHA if they ask for it. In fact, stick around and I'll play that for you at the end of this video. And in case you didn't know, I use Flipster not only to manage my wholesale business, but also my fix and flips. It has a budget tracker, contractor management center, and funding solutions, and much more. Now, to learn more and see it in action, just go to getflipster.com. So cross your fingers and say a prayer for me that my deal goes through without any hiccups, and watch my before and after slideshow and leave a comment and let me know what you think, and I'll see you on the next video.